Philanthropy is an important priority for many families. To maximize the impact of your charitable giving, it's important to understand key features such as flexibility and tax deductibility. Over the next few minutes, I want to go through 3 different aspects of charitable giving. One is what features you should consider when determining what charitable giving approach or vehicle to use. The second is to go through 6 different charitable giving vehicles and talk about how they work and some of the advantages and disadvantages. And the third is to do a head-by-head comparison of each of these vehicles to help you decide which one is right for you. I'm Todd Eckler, Executive Director of Fiduciary Trust Charitable, and I'm joined today by Kelly Garino, Vice President and Trust Counsel at Fiduciary Trust Company and a philanthropic expert. We're delighted to have you here today. Now I'd like to turn to talking about what features to consider when deciding what charitable giving vehicle to use. The first is the charitable tax deduction. So the charitable tax deduction varies somewhat by vehicle and also often depends on whether the donor is receiving a benefit. The second is flexibility. So the flexibility to determine what charity receives the gifts over time if it's in a vehicle. The third is control, and whether or not you have legal control after you contribute assets. The fourth is cost, the cost to set up and the cost to administer a charitable giving vehicle over time. And finally, there are other features that vary by vehicle, such as the ability to make anonymous gifts. So what are the different types of charitable giving vehicles? There are 3 different categories. The first is a direct gift, which is pretty well understood. A direct gift is simply a donor makes a gift of cash or other assets to a charitable organization and gets an immediate tax deduction. The second is a conduit gift. So in a conduit, the donor makes a gift to a charitable giving vehicle, such as a donor advised fund. And then over time, they recommend grants to a particular charity or other charitable purposes, depending on the vehicle. And then the third is split interest giving. So in split interest giving, the donor makes a gift to a charitable giving vehicle, and then over time, the donor may receive some sort of income stream, and typically the charity receives the remainder at the end of a particular period or the donor's lifetime, although there are different variants on that approach. So let's go into a little more detail about what each of these 6 approaches is like within these 3 categories. So why don't we turn to the first approach, which is direct giving. Clearly, direct gifts are a popular form of giving and well understood, but with the changing tax law at the end of 2017, IRAs have become a more popular way to give. Could you say a little more about why that's the case?
Certainly. So the term that we've been hearing the past year is qualified charitable distributions, or QCDs. And what this is a donor who is over the age of 70 and a half can direct a distribution from their IRA directly to a charity. They can donate up to $100,000 per year using this technique. The effect of this is that the donor, they don't receive an income tax charitable deduction, but they also don't recognize that distribution as income. So that's where the benefit lays in that. It also counts towards the donor's required minimum distribution from the IRA. So as you know, once an individual reaches age 70 and a half, you have to start taking assets out of the IRA. And so this technique allows those assets to come out to benefit charity instead of coming out to the donor and being taxed as income. It's somewhat important to work with an advisor when wanting to use this technique to work the numbers. You need to make sure that the tax benefit of doing the QCD is more beneficial than using maybe low basis assets that would be taxed differently also. So work with an advisor, work through the numbers on scenarios both ways to see what's more beneficial.
Well, definitely an option to consider if you're over 70 and a half and have a traditional IRA. Well, let's move and talk about the conduit gifts, so the donor advised funds and private foundations. So donor advised funds are increasingly popular. In fact, they've grown, according to National Philanthropic Trust, they've grown from 4% of charitable gifts in 2010 to nearly 10%, or actually over 10% in 2017.
That sounds about right.
Yeah, what's driving that? What are some of the benefits of donor advised funds?
Yes, so donor advised funds definitely are popular now. They're being used by more and more donors. What they are is just a separately identified fund at a sponsoring charity, and those sponsoring organizations are public charities. So if you want to establish a donor advised fund, you would identify a charity that has donor advised funds. You would transfer assets to the fund. At that time, you have given up legal control, so that's also when you get your charitable deduction. Generally, donors retain advisory rights to the donor advised fund, which means that as time goes on, you could recommend grants to be made out of the fund to an end charity that you want to benefit. And generally, the advisory rights, you'd also retain investment privileges. So the advantage of a donor advised fund is combining this immediate income tax deduction with the ability to extend grants to user charities over time. And there's flexibility in the structure also. You don't have to pick one charity. You can make grants to multiple charities. You can involve family members. Most donor advised fund sponsoring organizations, when you set up the donor advised fund and designate who the donor advisor is, you can also designate successor advisors. So perhaps you would name your children as successor advisors, and then that would be, you'd be able to continue the philanthropy to another generation. There are some limits on donor advised funds. There are some charities that cannot receive grants from the funds, and those are defined in the regulations, but most public charities are qualified charities to receive donor advised fund grants.
Well, given the flexibility and other features of donor advised funds, it's not surprising to see why they've become so popular. Now, private foundations, which is the other conduit giving approach, have also been around for a long time, probably a longer time than donor advised funds, and often named after families that you hear about. Of course, you don't have to be a billionaire to set up a private foundation. There are obviously a lot of small ones out there as well. Could you talk a bit about how they work, how they differ from a donor advised fund?
Certainly. So a private foundation is a separate legal entity. It's formed as a trust or a corporation. And they receive their funding from a single donor, as you mentioned, like maybe a single family or a small number of members of a family instead of many people from the general public. A primary appeal of creating a foundation is the level of control that the donor can maintain after establishing it. So the donor can have, or the founder can have, decision-making authority. They can decide who the trustees will be. They can be a trustee. They can designate successor trustees. So if you established your own family foundation, the Todd Eckler Family Foundation, you could include those aspects that you cared about in the organizing document and set up the structure in a way that made sense for your family philanthropy, not only for now, but also for many generations. There's no time limit to private foundations. They can continue operating for many generations, and often they do. As I mentioned, donors like the control that foundations provide. They also like the flexibility that foundations provide. So often they operate as grant-making organizations. So assets will be donated. Those assets will grow over time, and grants are made to end charities. That's why it's a conduit entity. But foundations also can engage in their own charitable activities. They aren't limited to just grant making. Those activities and giving programs can change over time as the family's philanthropy changes. They also can engage in mission or impact investing, program-related investments, and those are type of investments that aren't necessarily meant to provide a return to the foundation, but are meant to support causes within the community. In terms of tax efficiency, gifting to a private foundation is not necessarily as tax efficient as gifting to a public charity because there are lower limits on the deductibility of that gift. One of the other hurdles perhaps of private foundations is they're fairly complex vehicles, so you need to involve attorneys and accountants and other professionals in the setup stage, and also during the term of the foundation when you're operating the foundation. So the cost can be high to establish, but as we mentioned, the benefit is the control and also the flexibility of private foundations.
Terrific. Yeah, that's very helpful. It does give you a lot of ability to, from a legal perspective, direct what happens with the investments and where things go, and flexibility on the grant side. But as you mentioned, there's certainly costs associated with that. Now I want to switch gears and talk about split interest gifts. And one of the popular approaches is charitable gift annuities. I don't know about you, Kelly, but from the schools that I've attended, I often get mailings from them about charitable gift annuities. And these charitable gift annuities have attractiveness, particularly to retirees, because they enable you to receive an income stream, which can help with retirement planning, but also benefit the school that's involved. Could you talk more about how those work and some of the benefits?
Certainly. So a charitable gift annuity, as you mentioned, is a split interest gift. This just means that a portion of the gift, the benefit of the gift accrues to the donor, and a portion of the benefit of the gift accrues to the charity. A charitable gift annuity is a contract in which a donor agrees to give a certain amount of assets to a charity, such as the university, and the university agrees to pay an annuity amount to the donor or somebody else the donor designates. The amount of this annuity payment will depend on the age of the person who receives the annuity and also the amount of the gift, but it doesn't change over time. So even though market conditions or investment returns might change, the amount of the annuity payment doesn't change over the term of the annuity. While charitable gift annuities are more complicated than direct gifts, they still are fairly simple to establish, and they have that benefit of that steady income stream for the beneficiary. There's a little bit of flexibility with charitable gift annuities. You can only choose one charity. The contract is with a single entity instead of multiple entities, but you can decide how much to give, and you can decide who the annuitant will be. As I said, it can be the donor can name another individual or even a non-family member, although that might have gift tax implications. Charitable gift annuities can be a good choice, as you mentioned, for donors who want that income stream later in life or at a certain time during their life. And because the income payment of a charitable gift annuity is the charity's obligation under the annuity contract, the donor needs to assess the financial stability of the charity. Not all charities are large enough or sophisticated enough to be able to enter into this type of arrangement, but universities, as you pointed out, often are.
Thank you, Kelly. Clearly, a charitable gift annuity is valuable for someone who wants that fixed income stream for life. Of course, it's important to understand that if someone makes a gift and a year later the annuitant passes away, that the rest will immediately go to the charity, which is ultimately what the person's trying to do anyway. So let's switch gears to another split interest vehicle, which is a charitable remainder trust. It has a lot of the features of a gift annuity, but a lot more flexibility. So could you talk a bit about how those work?
As you mentioned, charitable remainder trusts are similar to gift annuities because they're a split interest gift. They're in that same category. However, a charitable remainder trust is not a contract between the donor and the charity. Instead, it is a tax-exempt, irrevocable trust that's established entirely by the donor. While a charitable remainder trust is generally more complex to establish than a charitable gift annuity, it also gives the donor more control and more flexibility. There are two main types of charitable remainder trusts. One is a charitable remainder annuity trust, which, similar to a gift annuity, distributes a specific annuity each year during the payment term. The other type is a charitable remainder unitrust, or CRUT, which distributes a fixed percentage of the trust assets that are valued out annually during the payment term. Charitable remainder trusts do provide flexibility to the donor. So when the donor establishes the trust, they can choose the various terms. For example, the donor can name himself or herself as the income recipient. They also can add a spouse as a concurrent recipient. They can choose the payment term for a life or a lifetime of one or more beneficiaries, or for a term of years, although it can't exceed 20 years. They also can choose the annuity amount or the unitrust amount between certain percentages set up by the IRS. The donor also can identify more than one charity, unlike a charitable gift annuity, as the remainder recipient of the funds. And they also could draft the trust so that the trustees could choose the charity after the term has ended. When a donor transfers assets to a charitable remainder trust, they're eligible for an income tax deduction at that time, even though no assets are transferred to charity until later.
Well, clearly, a charitable remainder trust provides a lot of flexibility that you don't see in a charitable gift annuity. Now, there's the other wrinkle on a charitable remainder trust, which is a charitable lead trust. And could you tell us how those work?
So in a charitable lead trust, the income stream first gets paid to a charity, and then the remainder, after either an individual's lifetime or a term of years, passes to the donor's named beneficiary. Unlike charitable remainder trusts, charitable lead trusts have no limit on their term of years for the charitable term, and there's no minimum or maximum to the annuity amount or the unitrust payment amount. Charitable lead trusts also differ in their tax benefits to the donor, so that's something to keep in mind when thinking about whether to use this vehicle.
Well, charitable lead trusts aren't as popular, but it's important for someone considering what vehicle to use to at least consider them depending on what their needs are.
That's right.
Now let's take a comparison of the different charitable giving vehicles that we just talked about and giving approaches. First, if you talk about the direct gift category, direct gifting is very simple in that it's a direct gift to the charity. There's no control after the gift is made. It's low cost to administer because there's not really anything else involved, and you do get the best charitable deduction. The second category is conduit gifts, and those are donor-advised funds and private foundations. On the donor-advised fund front, one of the features is grants can only be made to IRS-qualified nonprofits. Relatively low cost to administer, which is another advantage of them relative to a private foundation. And you get the best charitable deduction as well, much like a direct gift. Private foundation also has advantages. You get broad charitable uses of the funds are permitted, not just gifts to another charity, but you can also gift to, you can accept scholarship programs, you can hire people to do charitable work. The trustees are in full control, full legal control of the investments and the distributions, unlike a donor-advised fund where you recommend grants and things. They're more costly to set up and more time required to set up and administer private foundation. But you do get a favorable tax deduction, not as good as donor-advised fund and direct gift, but generally good tax deduction. If we look at the next category, which is split interest gifts, the three types that we talked about are charitable gift annuities, charitable remainder trusts, and charitable lead trusts. On the charitable gift annuity front, first of all, you're making a significant gift to one charity. You get guaranteed lifetime income stream to the donor or someone else that they name, which can be a benefit in retirement planning in particular. You don't have any control over the gift after it's made. It's just going to play out the way it was set up. There is a risk of insolvency of the charity that set it up, so you want to make sure you use a charity that has a strong financial position. And there's a less favorable charitable deduction because the donor or someone they designate is getting part of the money back that's contributed. The charitable remainder trust also can provide an income stream to the donor or others, but it has more flexible payment terms than a charitable gift annuity. The remainder still goes to the charity or charities that they name, but there's the flexibility to change who the charitable recipients are at some point after it's set up. It also, like a charitable gift annuity, has less favorable tax treatment because you are getting part of the money back going to the donor or someone that they designate. And finally, a charitable lead trust is very similar to a charitable remainder trust, only the income stream goes to the charities and the remainder to non-beneficiaries. It also has less favorable tax treatment than, say, a donor-advised fund or private foundation.
We hope that you found our review of these 6 charitable giving opportunities to be useful. All of this information is in a written article in detail. Please feel free to download that and use that as a reference guide. Choosing the correct charitable giving vehicle can be a difficult process. We here at Fiduciary Trust would be happy to help guide you in this decision.